going to turn to Michael Kriegel, another one of the attorneys on our HR and Benefits Library editorial team, to gain some further insights into the small business healthcare tax credit. Michael, how does the credit relate to cafeteria plans?
For purposes of the credit, including the 50% requirement, any premium paid pursuant to a salary reduction arrangement under a Section 125 cafeteria plan is not treated as paid by the employer. If the employer pays only a portion of the premiums for the coverage provided to the employees under the arrangement, with employees paying the rest, the amount of the premiums counted in calculating the credit is only the portion paid by the employer. For example, if an employer pays 80% of the premiums for the employee's coverage, with employees paying the other 20%, the 80% premium paid by the employer counts in calculating the credit. Take this example. Employer has one employee, employee D. Employee D's health insurance premiums are $100 per month and are paid as the following: $80 by the employer and $20 by employee D through salary reductions to a cafeteria plan. For purposes of the requirement for a qualifying arrangement and for purposes of calculating the amount of Section 45R credit, the amount of premiums paid by the employer is $80 per month.
I understand that, Michael. It makes sense. Can premiums paid by the employer in 2010, but before the new health reform legislation was enacted, be counted in calculating the credit?
Yes. In computing the credit for a tax year beginning in 2010, employers may count all expenses that are counted in calculating the credit for that tax year.
Does the healthcare tax credit allow employers to reduce employment tax payments, such as withheld income tax, Social Security, or Medicare taxes?
No. According to the IRS, the credit applies against income tax, but not employment taxes.
I see. How does the credit affect an employer's deduction for paying health insurance premiums?
In determining the employer's deduction for health insurance premiums as a Section 162 business expense, the amount of premiums that can be deducted is reduced by the amount of the credit.
Okay, as we said before, an employer must have fewer than 25 full-time equivalent employees, also known as FTEs. Let's cover a few questions the IRS has addressed on counting FTEs. How is the number of FTEs determined for purposes of the credit?
The number of an employer's FTEs is determined by dividing 1. The number of total hours of service for which the employer pays wages to employees during the year by 2,080. Note that no more than 2,080 hours of service may be attributed to any employee. The result, if not a whole number, is then rounded to the next lowest whole number. An employee's hours of service for a year includes each hour for which an employee is paid or entitled to payment for the performance of duties for the employer during the employer's tax year, as well as each hour of paid leave. When calculating leave, note that under the IRS rules, no more than 160 hours of service, typically about 4 work weeks, are required to be counted for an employee on account of any single continuous period of paid leave.
Michael, please give us an overview of how to calculate the hours of service.
Sure. To calculate the total number of hours of service which must be taken into account for an employee for the year, the IRS permits employers to use any of the 3 methods. 1. Under Method 1, determine actual hours of service from records of hours worked and hours for which payment is made or due, including hours for paid leave. The second method of calculating hours of service is days worked equivalency. Under this method, the employee is credited with 8 hours of service each day, for which the employee would be required to be credited for at least 1 hour of service under Method 1. 3. Employers may use a week's worked equivalency. Under this method, the employee is credited with 40 hours of service for each week, for which the employee would be required to be credited for at least 1 hour of service under Method 1.
I see. Well, that does make sense. Can an employer with 25 or more employees qualify for the credit if some of its employees are part-time?
Yes, because the limit on the number of employees is based on full-time equivalent employees, or FTEs, an employer with 25 or more employees could qualify for the credit if some of the employees work part-time. For example, an employer with 46 half-time employees has 23 FTEs, meaning they are paid wages for 1,040 hours, and therefore may qualify for the credit.
Okay. How do seasonal workers affect the calculation of FTEs?
while seasonal workers are disregarded in determining FTEs and average annual wages, unless the seasonal worker works for the employer on more than 120 days during the tax year. However, premiums paid on their behalf may be counted in determining the amount of credit.
Okay, if an owner of a business also provides services to it, does the owner count as an employee?
Generally, no. Under the rules, a sole proprietor, a partner in a partnership, or a shareholder owning more than 2% of an S corporation, and any owner of more than 5% of any other business are not considered employees for the purposes of the credit. Thus, the wages or hours of these business owners and partners are not counted in determining either the number of FTEs or amount of average annual wages, and premiums paid on their behalf are not counted in determining the amount of the credit.
I see. Do family members of a business owner who work for the business count as employees?
Generally, no. Under the rules, a family member of any of the previously discussed business owners or partners, or a member of such a business owner's or partner's household, is not considered an employee for purposes of the credit. Thus, neither their wages nor their hours are counted in determining the number of FTEs or the amount of average annual wages and premiums paid on their behalf are not counted in determining the amount of the credit. For this purpose, a family member is defined as a child or descendant of a child, sibling or step-sibling, parent or ancestor of a parent, step-parent, niece or nephew, aunt or uncle, or son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law.
How does eligibility for the credit relate to an employer who is a member of a controlled group or an affiliated service group?
Members of a controlled group or affiliated service group are treated as a single employer for purposes of the credit. Members of the controlled group generally are businesses with the same owners. An affiliated group generally consists of related businesses of which one performs services for the other. However, the rules for determining a controlled group or affiliated service group are contained in sections 414B, C, M, and O of the Internal Revenue Code.
Okay, the employer's average annual wages is an important component of being eligible for the credit. As we said, an employer must pay an average annual wage of $50,000 for the year. Let's go over a few questions relating to average annual wages. How does an employer determine average annual wages?
The amount of average annual wages is determined by first dividing the total wages paid by the employer during the employer's tax year to employees by the number of employers' FTEs for the year. The result is then rounded down to the nearest $1,000, if not otherwise a multiple of $1,000. Only wages that are paid for hours of service determined in accordance with the IRS rules are taken into account. Wages for this purpose means wages are defined for PPACA purposes without regard to wage-based limitation.
Okay, I understand that. Michael, please take us through an average annual wage example.
Okay, here's an example. For the 2010 tax year, an employer pays $224,000 in wages and has 10 FTEs. The employer's average annual wages would be $22,000. This figure is obtained by dividing $224,000 by 10 to equal $22,400, rounded down to the nearest $1,000.
Okay, now we're going to switch gears and address a few questions about claiming the credit. How does an employer claim the actual credit?
The Internal Revenue Service has released a draft version of the form that both small businesses and tax-exempt organizations will use to calculate the Small Business Health Care Tax Credit. Small businesses will claim the credit on their annual income tax return with an attached Form 8941 showing the calculation of the credit. Tax-exempt organizations will claim the refundable credit by filing a Form 990-T, which will be revised for 2011 filing season, with an attached Form 8941 showing the calculation of the claim credits. The IRS expects the final version of Form 8941 and its instructions to be available later this year.
Michael, may an employer use the credit to offset its alternative minimum tax, or of course AMT, liability?
Yes. Under the rules, the credit can be used to offset an employer's AMT liability for the year, subject to certain limitations based on the amount of the employer's regular tax liability, AMT liability, and other allowable credits.
Great. May an employer claim the credit if it has neither taxable income nor AMT liability for the year?
Generally, no. Except for tax-exempt employers, the credit for a year offsets only an employer's actual income tax liability or AMT liability for the year, subject to certain limits based on the amount of the employer's regular tax liability, AMT liability, and other allowable credits. Employers should note, however, that as a general business credit, i.e., an unused credit amount can generally be carried back 1 year and carry forward 20 years. Because an unused credit amount cannot be carried back to a year before the effective date of a credit, an unused credit amount for 2010 can only be carried forward.
Is there an exception for this rule for tax-exempt employers?
Well, for a tax-exempt employer, the credit is a refundable credit. Thus, even if a tax-exempt employer has no taxable income, the tax-exempt employer may receive a refund. The refund, however, may not exceed the income tax withholding and Medicare tax liability.
May an employer use the credit to determine estimated taxes for the year?
Yes.
What effects do state credits and state subsidies for health insurance have on the amount of the federal health care tax credit?
Some states offer tax credits to certain small employers that provide health coverage to their employees. Some states also offer premium subsidy programs for certain small employers, whereby the state pays a portion of the employee's health insurance premiums. If an employer is entitled to a state tax credit or a premium subsidy that is paid directly to the employer, the following will take place. The premium payment made by the employer is not reduced by the state credit or subsidy for purposes of determining whether the employer has satisfied the qualifying arrangement requirement to pay an amount equal to a uniform percentage of the premium cost. The uniform percentage cannot be less than 50% of the premium cost. Also, except as described in IRS rules, the maximum amount of the federal health care tax credit is not reduced by reason of a state tax credit or by reason of payments by the state directly to an employer.
Thank you very much for joining us today. We look forward to providing you with new webinars and helpful HR and benefits resources.